Most people have been taught to save for a rainy day. But want to hear something crazy? When you put money in the bank nowadays, you usually lose money. I will explain. How does that work? The problem is that when interest rates are lower than inflation, meaning that your money is actually worth less in the future than it is now. So, it's not that you put in €100 and get out €95, but that the €100 you worked so hard to save can have less purchasing power. That doesn't mean saving is bad, it's still how we get enough money together for important things in life like weddings, a first home, or a family emergency. And putting money in the bank is, needless to say, a lot safer than keeping it under the mattress. So where can you get a stronger sword in the battle against inflation and still keep your money safe? Thanks for watching, and don't forget to like and subscribe. In order to combat the erosion of your savings due to inflation, you may want to explore alternative options that offer better interest rates while still keeping your money safe. I am introducing a few options to consider. High-yield savings accounts. These accounts typically offer higher interest rates compared to standard savings accounts. They are still very safe because they are often Federal Deposit Insurance Corporation, an independent agency created by the Congress to maintain stability and public confidence in the nation's financial system, which means your deposits are protected up to a certain limit. Certificates of deposit. A savings product that holds a fixed amount of money for a fixed period and pays interest. The money must remain untouched for the term or risk penalty fees or lost interest. CDs are considered one of the safest savings options and offer higher interest rates than traditional savings accounts. Are mostly issued by banks, thrift institutions, and credit unions in the United States. Some mainstream bank certificates of deposit have very low interest rates, but there are online banks and credit unions that may offer more competitive rates on CDs. Be sure to shop around for the best rates and consider longer-term CDs, as they often offer higher yields. Inflation-protected securities. Specifically designed to protect against inflation. They provide a guaranteed return that adjusts with changes in the consumer price index, helping you maintain your purchasing power. Inflation-protected securities are a type of fixed-income investment that guarantees a real rate of return, are issued by the US government as Treasury inflation-protected securities. Their face or principal value is indexed to inflation and adjusted for changes in prices. They pay interest on the adjusted value, creating a rising or falling stream of payments depending on inflation or deflation. They are not risk-free. Investing in bond mutual funds or exchange-traded funds can provide higher returns than traditional savings accounts. However, they come with some level of risk, so you should carefully consider your risk tolerance and investment horizon. For bond investors, 2022 was a grim year. The bond market as measured by the Morningstar US Core Bond Index lost 12.9%, while funds in the intermediate-term Core Bond Morningstar category lost 13.4% on average. The first quarter of 2023 turned out to be a roller coaster for the bond market, as expectations for the Fed swung widely. It was first believed there'd be an end to the rate hikes, and then the consensus formed that there'd be more tightening as economic data proved stronger than expected and inflation remained high. But as the second quarter ended and the third quarter got underway, bonds rallied after the collapse of Silicon Valley Bank led to worries about a recession kicked off by a credit crunch. Stocks and equities. While stocks can offer significant returns over the long term, they also come with higher volatility and risk. Consider investing in a diversified portfolio of stocks or equity ETFs if you have a longer investment horizon. Real estate. Real estate investments, such as real estate investment trusts, REITs, can provide income and potential appreciation. However, they may require more significant capital and involve some risk. REITs generate a steady income stream for investors but offer little in the way of capital appreciation. By law, REITs have to pay at least 90% of taxable income to shareholders. It's not uncommon to have a 5% dividend yield or more. REITs also have the potential for capital appreciation as the value of the underlying assets increases. Investing in REITs can be a good option for those who want to invest in real estate but do not want to deal with the hassle of owning and managing properties themselves. However, like any investment, they come with some risks. It's important to do your research and understand the risks before investing in REITs. Retirement accounts. Retirement accounts are a great way to save money and invest for the future. There are many types of retirement accounts, each with different advantages to help you get the most bang for your buck. Contributing to retirement accounts can be a way to grow your wealth over time, with tax advantages. These accounts often offer various investment options, including stocks and bonds. Remember that each of these options comes with its own set of advantages and risks, and the best choice depends on your financial goals, risk tolerance, and time horizon. Diversifying your savings and investments across multiple asset classes can help you strike a balance between preserving capital and achieving growth to beat inflation. It's a good idea to consult with a financial advisor to create a strategy that suits your specific circumstances. Thanks for watching the video. If you have any questions or need further information, feel free to ask. And yes, don't forget to like and subscribe for more helpful content.